What if I told you that during the pandemic, the companies you'd think were the most fragile, the ones with the shakiest access to funding, actually built the biggest financial war chests? And what if that mountain of cash is the very thing that shielded them from the barrage of Fed rate hikes that began in 2022? It's a completely counterintuitive idea, but a new research note from the Fed suggests it might just be true. Stick around, because we're about to unpack why the most vulnerable companies might have been the most prepared. This is FedSpeak. All right, team, let's get into the latest Fed's notes from researchers Ely Singer and Ji Yang. They dug into how U.S. non-financial companies handled their cash during the COVID-19 pandemic, and the top-line finding is pretty staggering. Just take a look at this first chart showing the cash-to-assets ratio for public U.S. companies. For years after the 2008 crisis, the median firm held about 12% of its assets in cash. But during the pandemic, that number surged to a historic high of over 20%, with the average shooting past 30% in 2021. So companies were hoarding cash like never before. But the real question the researchers wanted to answer was who was doing the most hoarding and why? To figure this out, they split companies into two groups: financially constrained firms, those that have a tough time getting loans or raising capital at a good price, and unconstrained firms, who have much easier access to funding. They also divided the pandemic into two distinct periods: the early pandemic in 2020, which was defined by extreme uncertainty, and the late pandemic in 2021, when vaccines rolled out and things started looking a bit brighter. Now, the classic theory is that constrained firms should save more as a precautionary motive. They need a bigger rainy day fund because they can't just run to the bank when trouble hits. The pandemic put this theory to the ultimate test. The researchers crunched the numbers in a detailed regression analysis, and they confirmed that on average, more constrained firms saved more cash than less constrained firms. That's the precautionary motive in action. But here's the fascinating part. This effect went into overdrive during the pandemic, and it was most pronounced in the late pandemic period of 2021. This next chart really visualizes the story. As the economy started to improve in 2021, you can see that less constrained firms felt confident enough to start spending down their cash piles. But the most constrained firms did the opposite. They kept accumulating cash, maybe because they were slower to believe the good news. This created a massive gap in cash holdings by the end of 2021. But the story has another layer. Not every industry experienced the pandemic the same way. We all felt the uncertainty, but for some sectors, airlines, hotels, restaurants, auto manufacturers, the economic shock was immediate and severe. The researchers called these the hard-hit industries. This created a kind of natural experiment. What happens to constrained firms when the theoretical bad day they were saving for actually arrives? Well, the results flipped entirely. The data shows that within these hard-hit industries, the opposite happened. The most constrained firms simply couldn't afford to save more. They were in survival mode. This final chart makes the contrast crystal clear. The gray bars show that in most industries, being more constrained meant saving more cash. But the red bars, representing the hard-hit sectors, show that the most constrained firms there actually saved less than their unconstrained peers. They were likely burning through cash just to meet payroll and keep the lights on. It reveals a critical non-linearity. Being a little constrained makes you save for a rainy day, but being severely constrained during a hurricane forces you to drain your savings just to stay afloat.
So, what's the big takeaway for us as investors? This completely reframes how we should think about corporate resilience. The headline finding is that, broadly speaking, the firms we considered most vulnerable heading into the 2022 rate hiking cycle were sitting on the largest cash buffers in modern history. We all assumed that rising interest rates would immediately crush these smaller, financially constrained companies because their borrowing costs would skyrocket. But this research suggests many of them had a secret weapon, a massive pile of cash they'd hoarded out of pandemic-induced fear. That cash acts as a powerful shield. It allows a company to fund its operations and investments without having to go to the capital markets and pay those punishingly high interest rates. So, the very firms that are most sensitive to interest rates may have been the best insulated, at least initially. The analysis of the hard-hit industries is also a huge lesson. It tells us that while precautionary savings is a powerful force, it has a breaking point. For the most constrained firms in the absolute worst-hit sectors, the crisis was so severe it overwhelmed their ability to prepare for the future. They had to spend their rainy day fund while it was still pouring. This means that when we analyze companies in crisis-hit sectors, we can't just look at their balance sheets today. We have to understand how much damage they sustained just to get here. Okay, how does this change my perspective or how I might screen for opportunities? First, I'm going to be less willing to automatically write off a company just because it fits the traditional definition of financially constrained, especially when heading into a tightening cycle. This research note forces me to add another step. I can't just look at their access to capital, I have to look at their balance sheet from the end of 2021 and see if they built up that precautionary cash hoard. A company that looked risky on paper might actually be sitting on a fortress of liquidity. Second, it reinforces the need for deep industry-level analysis. I can't apply a broad market theme like rate hikes hurt small companies universally. The data here is clear. The experience of a constrained tech firm was wildly different from that of a constrained airline. When I'm looking at a company in a sector that got truly decimated, like travel or specialty retail, I'll be paying extra attention to its cash burn during 2020. The ones that survived without completely depleting their reserves are likely the strongest players in that space. Finally, it's a reminder to question the narrative. The story in early 2022 was about the impending doom for companies with weak access to credit. But the data shows a more complex reality. The firms that were most scared were, in a way, the most prepared. As an investor, my job is to find those disconnects between the popular story and the underlying data. This Fed's note provides a perfect example of one of those disconnects. Disclaimer: this is not financial advice. All opinions are for informational and entertainment purposes only. Please consult a professional for your financial decisions.